What is up, crypto fam, and welcome back to Bitcoin Bulletin, your ultimate source for the pulse-pounding news shaping the digital asset landscape. Get ready, because the market is absolutely on fire, and we've got a rapid-fire rundown of the updates you simply cannot afford to miss. From institutional titans making massive moves to groundbreaking financial shifts, the pace of innovation is relentless, and if you blink, you might just miss the next big wave. We're diving deep into the forces pushing Bitcoin towards that mind-blowing $1 million mark, unpacking the latest strategic plays from major corporations, and dissecting the critical regulatory shifts that could redefine how businesses hold digital assets. Plus, we're exploring how the very foundation of crypto liquidity is setting the stage for Bitcoin's next explosive surge. We're diving deep into the forces pushing Bitcoin towards that mind-blowing $1 million mark, unpacking the latest strategic plays from major corporations, and dissecting the critical regulatory shifts that could redefine how businesses hold digital assets. Plus, we're exploring how the very foundation of crypto liquidity is setting the stage for Bitcoin's next explosive surge. You want to stay ahead? You've come to the right place. Stick around, hit that like button, subscribe, and ring that notification bell so you never miss a beat on Bitcoin Bulletin. The million-dollar question: is Bitcoin truly digital gold? As the digital asset space continues its meteoric rise, a significant narrative is solidifying: Bitcoin as the new gold standard. This isn't just hype. It's a movement fueled by powerful forces, most notably institutional adoption and the inherent scarcity of Bitcoin itself. We're witnessing a seismic shift where traditional financial players are not just dipping their toes in the water, but diving headfirst into Bitcoin, bringing with them vast capital and a renewed legitimacy to the asset class. This influx of institutional money is a critical catalyst, signaling a broader acceptance and integration of Bitcoin into the global financial system. Think hedge funds, asset managers, and even large corporations, all reevaluating their portfolios and recognizing the unique value proposition that Bitcoin offers. But what exactly is driving this institutional embrace? It's a potent cocktail of factors. Firstly, Bitcoin's fixed supply, capped at 21 million coins, makes it a deflationary asset, a stark contrast to fiat currencies that can be printed at will. This scarcity is its superpower, positioning it as a potential hedge against inflation and a store of value in an increasingly uncertain economic climate. This digital gold narrative resonates powerfully with investors seeking to preserve wealth. Secondly, the technological advancements and growing infrastructure surrounding Bitcoin, including the development of regulated derivatives, custody solutions, and even spot ETFs in some jurisdictions, are making it easier and safer for institutions to engage. These developments are chipping away at the perceived risks, paving the way for wider adoption. Analysts are pointing to this convergence of scarcity and increasing institutional access as the primary drivers for Bitcoin's ambitious price targets, with many now openly discussing the potential for Bitcoin to reach the $1 million mark. This isn't just a speculative dream. It's a projection based on the fundamental economic principles of supply and demand, coupled with the growing recognition of Bitcoin as a unique asset class capable of storing value and facilitating transactions in the digital age. The implications are profound, suggesting a future where Bitcoin plays a pivotal role in both individual and institutional investment strategies, potentially reshaping the global financial landscape as we know it. The market is buzzing with speculation and excitement as these institutional players continue to pour capital into Bitcoin, solidifying its position as a digital store of value. Now, speaking of major players making bold moves, another titan of industry is doubling down on their Bitcoin strategy, and the reasons might surprise you. Corporate powerhouse bets big on Bitcoin, a strategic masterstroke. In a move that has sent ripples through both the corporate and crypto worlds, a prominent business intelligence and software company has once again demonstrated its unwavering commitment to Bitcoin by continuing its aggressive acquisition strategy. This sustained purchasing activity, even amidst fluctuating market conditions and occasional legal headwinds, underscores a deep-seated belief in Bitcoin's long-term value proposition and its potential as a foundational treasury asset. The company's treasury strategy has become a closely watched indicator for broader corporate adoption trends, and their latest acquisitions signal a clear continuation of this bold approach. This isn't just about accumulating digital currency. It's a strategic pivot that redefines how corporations manage their balance sheets and hedge against economic volatility. By allocating a significant portion of its corporate treasury to Bitcoin, the company is not only diversifying its assets, but also positioning itself at the forefront of a potential financial revolution. The rationale behind this sustained accumulation is multifaceted. Firstly, the company views Bitcoin as a superior form of money, possessing unique properties like scarcity, divisibility, and portability, which make it an attractive asset in a world grappling with inflation and currency debasement. They are betting on Bitcoin's ability to preserve and grow purchasing power over the long term, much like gold has historically done, but with the added benefits of digital innovation. Secondly, the legal relief the company has recently experienced, particularly concerning its prior Bitcoin acquisitions and related tax treatments, appears to have provided a significant confidence boost. This legal clarity removes a layer of uncertainty, making it easier for the company and potentially other corporations to pursue similar strategies without the same level of regulatory apprehension. The company's leadership has consistently articulated a vision where Bitcoin serves as a primary treasury reserve asset, a move that challenges traditional corporate finance norms and signals a significant shift in how corporate value is perceived and managed. Their continued buying spree suggests they see current market prices as an opportune moment to expand their holdings, anticipating future appreciation. This strategy is not without its critics, but the company's persistent dedication suggests a conviction that is hard to ignore, potentially setting a precedent for how other publicly traded companies approach digital assets in their financial planning. The market is keenly observing this corporate giant's persistent accumulation, seeing it as a strong signal of enduring institutional confidence in Bitcoin's future. Now, as major companies embrace Bitcoin, new financial frameworks are emerging to support these strategies, and one particular accounting standard is making waves. Accounting for the future: how a new standard unlocks Bitcoin for treasuries. A recent accounting pronouncement is set to dramatically alter the landscape for companies holding Bitcoin on their balance sheets, potentially unlocking significant new avenues for corporate treasury management. The Financial Accounting Standards Board, FASB, has issued an Accounting Standards Update, ASU 2020-308, which specifically addresses how intangible assets, including Bitcoin, should be accounted for. This is a game changer, as it moves away from previous, more restrictive accounting treatments that often obscured the true value and volatility of digital assets held by businesses. Historically, accounting for Bitcoin has been a complex and often unfavorable affair for companies. Under previous guidelines, Bitcoin was typically treated as an intangible asset with an indefinite useful life, meaning companies had to record impairment losses if the market value dropped below the carrying value, but they couldn't recognize gains until the asset was sold. This created a lopsided view of a company's financial health, as significant unrealized gains were invisible, while temporary downturns could trigger accounting write-downs. This created a disincentive for many businesses to hold Bitcoin as a treasury asset, despite its growing appeal as a store of value and potential inflation hedge. The new FASB ASU 2020-308, however, introduces a much more favorable and realistic accounting framework. It allows companies to account for Bitcoin differently, treating it more akin to other financial assets. Crucially, this update permits the recognition of unrealized gains and losses on Bitcoin holdings. This means that as the price of Bitcoin fluctuates, companies can now reflect these changes directly in their financial statements, providing a more transparent and accurate picture of their financial position. For treasury firms and companies looking to incorporate Bitcoin into their reserves, this is monumental. It simplifies the accounting process, reduces the punitive impact of price volatility on financial reporting, and importantly, aligns the accounting treatment more closely with the economic reality of holding a volatile yet potentially appreciating asset. This could spur a significant increase in corporate adoption of Bitcoin, as the accounting hurdles are substantially lowered. Experts believe this change will not only benefit existing Bitcoin holders, but also encourage new entrants, particularly those in the financial services sector who manage significant digital asset portfolios, to adopt Bitcoin more readily as a treasury asset. The implications extend to regulatory clarity and investor confidence, as standardized and transparent accounting practices are vital for mainstream financial markets. This new accounting standard is already generating buzz, with analysts predicting it will significantly boost corporate treasury adoption of Bitcoin. And as more companies embrace digital assets, understanding the broader market currents is key, especially when it comes to the very flow of funds that powers crypto. The unseen engine: how crypto liquidity and stablecoins predict Bitcoin's next move. In the dynamic and often volatile world of cryptocurrency, understanding the underlying mechanics that drive price action is crucial for any serious investor or observer. While headlines often focus on price surges and dips, a deeper analysis reveals that the health and growth of crypto liquidity, particularly through the lens of stablecoin expansion, can serve as a leading indicator for Bitcoin's future momentum. This connection is not merely theoretical. It's a reflection of how capital flows into and out of the digital asset ecosystem. Liquidity, in essence, is the ease with which an asset can be bought or sold without significantly impacting its price. In the crypto market, robust liquidity ensures smooth trading, tight bid-ask spreads, and overall market stability. Stablecoins, pegged to fiat currencies like the US dollar, play a pivotal role in this ecosystem. They act as the primary on-ramp and off-ramp for capital entering and exiting the crypto markets, and also as a stable medium of exchange within the ecosystem. When stablecoin supply grows significantly, it indicates that more capital is entering the crypto space, seeking investment opportunities. This influx of capital can then be directed towards major assets like Bitcoin, driving up demand and consequently price. Conversely, a contraction in stablecoin supply often signals a deleveraging or a flight to safety, potentially preceding a downturn in Bitcoin's price. Recent trends show a notable expansion in the total supply of major stablecoins, correlating with periods of increased Bitcoin accumulation by both retail and institutional investors. This growth in stablecoin liquidity is essentially a reservoir of dry powder, ready to be deployed into assets like Bitcoin when market conditions are favorable. Furthermore, the increasing sophistication and adoption of decentralized finance, DeFi protocols, which heavily rely on stablecoins for lending, borrowing, and trading, further amplify the importance of stablecoin liquidity. As these platforms mature and attract more users, the demand for stablecoins rises, creating a positive feedback loop that can ultimately benefit Bitcoin. Analysts are closely monitoring stablecoin issuance and redemption data as a key metric to gauge the overall health and sentiment of the crypto market, using it as a barometer to predict potential shifts in Bitcoin's trajectory. The interplay between stablecoin growth and Bitcoin's price action highlights a critical, yet often overlooked, driver of market performance, suggesting that the true momentum of Bitcoin may be best understood by looking at the foundational liquidity that supports it. Market watchers are increasingly citing the robust growth in stablecoin liquidity as a strong predictor of positive momentum for Bitcoin in the near future. And that wraps up our deep dive into the forces shaping the crypto landscape. But before you go, let's hit you with a lightning round recap of today's hottest stories. And that wraps up our deep dive into the forces shaping the crypto landscape. But before you go, let's hit you with a lightning round recap of today's hottest stories. Bitcoin's path to 1 million is being paved by institutional adoption and its digital gold scarcity. MicroStrategy is doubling down on its Bitcoin strategy, signaling a strong corporate belief amidst legal clarity. A new FASB accounting standard is making it easier for firms to hold and report Bitcoin, paving the way for wider adoption. And watch those stablecoins, their growth is a key indicator for Bitcoin's next big move. Don't miss out on any of these pivotal updates. Smash that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto intelligence, and ring that notification bell so you're always in the know. Follow us on all social platforms for even more insights. We'll see you in the next one.